Weekly stock market update. It is Thursday, the 12th of September. Okay, we're going to cover ETFs. We're going to cover why the market's fallen in September and why you shouldn't really panic. And we're going to look at some good new opportunities as well. Don't forget to look at campaignforamillion.com. Don't forget, none of this is a solicitation to purchase or sell any securities. This is not individual financial advice. And that book of mine, my ninth, this one to be published by the Financial Times, should be out very soon. So where are we on valuations? You're paying $26 for every future dollar of expected profits in Microsoft. Very similar to what you're paying for Nvidia. However, the cheaper ones are these. Unfortunately, the reason you're paying so much, i.e. $29, $26 for these, is because these are expected to grow more than energy stocks or even banks are. So you're paying a premium. The downside of that is they're expensive. The downside of that is also that given you're paying so much, if they should miss any numbers by even a little bit, they will fall more. So they're expensive, expected to reward you more, but they are likely to fall more with slight misses, whereas these are not expected to reward you more, but they're expected to fall less should they miss numbers. There's reward and risk for you, encapsulated in simple terms. What about the earnings calendar of the S&P 500? Adobe's coming out today, won't move the market. Okay, and we'll look at Adobe in a second. Don't forget to like, comment, share, please. It really helps the algorithm and make sure that it gets shared with more people. Now, remember, whatever I do throughout all of this, I will be looking for companies which are undervalued, because this is what doing your due diligence is. This research and getting these numbers is based upon the Nobel Prize-winning literature of Eugene Fama, Daniel Kahneman, Richard Taylor. They're the three people that I owe the most to in terms of coming up with that. Valuation of companies is more important, we know, as a factor for stock price moves than is growth, than is income. But we know we need to look at all of those. Croakey comes from Goldman Sachs Wealth Management. Momentum comes from AHL, Brevin Howard, all those kinds of hedge funds which are momentum based. Sortino and Alpha are statistical measures. It's a way to cheat and short circuit the market. In other words, we're looking for high average returns with very low risk of missing them. Okay, and Alpha is if there's a headwind, we do better. If there's a tailwind, we shouldn't fall as far. So that's really where you're looking for resilience in stocks. That's what all of this encapsulates. How's the past week been? Where to put myself? Well, the past week is less relevant than the longer term. Over the course of 30 seconds or a minute, the market moves really like a random Brownian motion, if you remember your biology from school. But over the longer term, over 12 months, it tends to move more in accordance with fundamental values. Okay, so when people say the markets are random, they're looking at a very short space of time. So that's why over the past year, this is what it looks like, which is pretty bloody attractive, I would have thought, to anybody, these kind of returns. And what we're trying to do in our pensions, and if you're self-employed or you're worried about your lack of pension growth and you want the transparency to be able to capture these opportunities, then you need the data and you need help. So have a look at the links in the bio regarding that. But over the past year, we've had the opportunity to pick some of these. Now, if we were really clever, we would only have bought that and nothing else. But like Warren Buffett, we don't just buy one stock. That would be too risky. Instead, what we do is we go through the data and look at the projections going forward from the current growth and the value growth, income, cash flow, Sortino, Alpha, all of those things, and then come to a conclusion of which ones we want to narrow down in for our appetite. Your appetite might be different. That's why we give you all 10,000 in the spreadsheet. If you're on the program, exchange traded funds, that's what they look like. I won't talk about it here. I've written an article about it on my LinkedIn. If you want to, on both my LinkedIn and my Telegram, that's freely available on alpeshpatel.com/links. Year to date, well, S&P's up 15%, Nasdaq's up nearly 12%. Okay, but notice how it is never a smooth ride. And to show you that, I'm going to give you that explanation in just a second, why it's never a smooth ride. We don't pick on sectors, but you can see the sectors doing the best are utilities, up 23%. There you go. Not what you'd normally have expected to be the leading sector. We look for underlying companies, and if that happens to include utilities, and I'll come to some in a second, then so be it. There's financials, and I'll come to those, communications companies, as well. So where's tech? Well, tech's all the way down here actually. So all those blindsided by that, it's useful to have all this other information, isn't it? What about the factors which are relating to stock market price movements? Well, momentum is important, valuation is important, growth is important. As you know, when we're looking at giving data and information to people for their pensions to help them grow more, we say you should have stocks which meet the value box, tick also growth within that, and within that the subset of income. What does that mean? Well, that means out of 10,000 companies on a spreadsheet, we can filter that down, give you all the data of 10,000, but also then filter it down for you and then leave you with just about 200. Because why would you not filter to such a very high standard if you're getting lots of applications? It's like a university. If you're getting lots of applications, why not filter until you've got the best of the best? If you're getting no applications, you'll let anybody in. Okay, so where are we over the past 1 year? Remember, markets don't move in a straight upward line, but the NASDAQ and the S&P up 23%. Now imagine if your pension has been just doing next to nothing each year, year after year. But imagine if in 1 year it does just even match the index and goes up 23%, then continues doing not much every single year. Well, even 1 year makes a massive difference. Now, if you happen to have 100,000 in your pension, that could be an extra 23,000. If you got $1 million, that's $250,000. And even if that only happens in 1 year out of 10, and all the other years you just do mediocre performance, you've still elevated at a higher growth path and trajectory. And I can't guarantee what the future will look like, but I can probably guarantee near as damn it in the next 7 years we're going to get another year where, at least one other year where we get at least a 23% rise in the market. And that's what my pension's about, it's what other people's are about. Of course, we'd love it if every single year we got 23 or 40 or 50%. It's all in the hands of the markets. The markets might never ever go up again. Chances are they'll do in the next 7 years what they did in the last 7. Okay, so where are we on the FTSE 350? That's where we are. They're the biggest moves of the past month. More importantly for me, for my SIP, my ISA, my son's junior ISA and SIP, where are we on the S&P 500? Well, we're still a bit overbought. September tends to be a bad month, so no reason to panic. The momentum, which is measured by this, still on the upward trend. However, it's looking a lot like this period. So whilst we haven't had any falls yet, what I would be more inclined to do is I continue holding the S&P 500 index that I have since January 2023, because that's when the momentum stopped falling and this was going flat. So we have this buffer and I'm continuing to hold it. Would I buy it today? Well, you've got the risk of that it's very overbought, not much more upside. So I probably wouldn't buy it today if I didn't already own it, unless I was particularly risk-loving. I generally am not risk-loving with my pension. NASDAQ, similar kind of story. You can ignore these falls. These are baby bears. In other words, whilst the momentum is rising, these falls can be ignored. That's a mama bear where the MACD is falling, but it can also be ignored. At least you know what it is. It's only when it's in the top 25% of this graph and it's falling from a great height does it suggest that the momentum is going to have a prolonged trajectory downwards. Nothing's guaranteed in life other than death and taxes, but that tends to be a pretty good indication where we are on that. So would I buy more today at the NASDAQ? No. Am I continuing to hold what I've got since January 2023 in my pension? Yes. Okay, FTSE 100 chugging along. It might be about to just have a consolidation or downward phase for a few months. So if you are worried about your pension and wondering why your fund manager for the next 3 months gets you a 0% return, it's probably because they're overexposed to the UK markets, which would be idiotic if you happen to be in the UK, because you're already exposed to the UK markets by living and working here. So they really should be diversifying you by having in your SIP and ISA something outside of the United Kingdom. But they're not usually that bright. Price over the past month on the S&P, these are the biggest movers. Let's have a look at these to see if there's any opportunities in those, given how much they've moved in the past month. See if we might have missed the boat in some of them. If we have, so be it. Okay, remember my usual holding period is 12 months. Now, this meets my value growth income because it's a score of 7, so anything 7, 8, 9 or 10, and that is moving up quite nicely. So this would actually hit all the criteria. The only thing for you to worry about is twofold: risk and reward. First of all, you look at the angle of inclination in the past and you say generally on an upward trend it moves at this kind of an angle. So if it does that again over the next 12 months, will that give you at least a 40% return? If that angle of growth doesn't give you a 40% return because you're relying for a margin of error, then that reward is not sufficient for you and you shouldn't buy the stock. Equally, that's reward. What about risk? The risk is the drawdown depth and duration. Now, drawdown depth and duration varies from person to person. If your depth that you're happy to take a fall is, say, 20%, then that's your depth in your risk appetite. Your duration, you can put it on a t-shirt or you can tattoo this on your arm, might be, say, 6 months. If you're looking at anything below 20 and 6, i.e. something like this, as opposed to something like this, you'll have far less choice. Anything less than 20 and 6, and you probably shouldn't be in individual stocks, you should be in funds. Okay, just so you know, there's a good measure. Right, for me, it's closer to 30 and 9. That means I've got a lot more choice and therefore more opportunities to pick from. Starbucks is a 7, so it ticks the value growth income box, but I'd really rather see this, for safety's sake, cross above the moving average. Again, even that doesn't guarantee, because it didn't there, that it'll continue upwards. It can still collapse, and this may well do that. You might look at this and say, well, I don't want in this because actually, Alpesh, I've noticed that it can have these prolonged downward periods. I know they got rid of the CEO, but turning a big boat like Starbucks takes a long period of time. So if you don't like that volatility, those drawdown depths and durations, don't be in it. Keysight Technology doesn't meet value growth income, and whilst it's oversold, hasn't crossed above its moving average. So a bit too premature and early for me, and I don't like the volatilities surrounding it. So not my risk appetite, thank you very much. I'm not here to speculate. 8, so Oracle does meet value growth income, but it's a bit overbought. Now, in the past, 20% of the time, when companies are overbought and the MACD gets broken to the upside at a sharp angle, and it failed to do it there, but at a sharp angle like here, it can continue going upwards and upwards, and Oracle will keep talking about AI, and it will keep going upwards and upwards, potentially. Just be warned, sometimes this happens, and that's your exit if the line crosses below its own moving average. So on your own risk appetite, be it. Clorox 7, fine. And not only that, that's going in the right direction. It is volatile though, but it's a 7. So, and most analysts hate it, and September's an awful month. So more risk appetite than I'd want to take, but it does tick several of the boxes. But that's why I like to draw to your attention, draw down depth and duration and projections forward as well. So as with most things in life, you should be saying no 90% of the time. Okay, 99% of the time probably. United Continental Health 7, it's chugging along. I hate the look of that sideways move. I know these people love it, and I know these 3 months can be rather good for it, and maybe it'll go from 48 to God knows where, but there's a lot of overhead resistance. Too many red flags for me. ResMed, great, and I continue holding it, and that's the direction. Okay, Cooper Companies 7, yeah, but I don't like that volatility. Okay, Walmart 8, great. However, you're really having to buy this on the basis that the MACD was broken to the upside, and that's risky because it means it's overbought, might continue upwards. Now, we will in the future, this is why my lifetime clients love it, we will in the future get a Walmart or some other company, a Costco, which will come back to this kind of pattern again. And when it does, and it's in 7, 8, 9, or 10, we will get this return again in our pension and double our money in that investment in our pension. This one, not for me. Obviously, that's awful. Costco, again, when we have this scenario again, which will take this to go down, we will get back in and we will ride doubling of our money again in that stock. But at the moment, overbought, and you'd only be able to buy it on the basis that you're willing to take that higher risk, that it's broken above, and it could drop back as it did there. Okay, so higher risk if you wanted it, but not for me. Apple, I continue holding. Amazon, I continue holding because I don't have the reason of the daddy bear, which is that, to exit yet. Same with Microsoft. Meta I got out in April because I rebalanced, because remember, I owned it since then, and my son's junior ISA was basically moving. Each time this even burped, my son's junior ISA, because it had these massive gains, was moving too much. So I got rid of Meta back then, and I wouldn't really get in at the moment because it looks a bit like it's going to be around there. More to come, but don't forget to look at YouTube where you'll see videos of me talking about the markets. Bank of America, nicely chugging along. Would I buy it today? Well, it hasn't got a 7, 8 or 9, so on your sort of risk appetite, be it. Netflix, I don't own, as you know, but since then, when the big results came in, I did discuss it and say, let's just look at it on, and at that point, value growth income was 7, 8 or 9, and this was moving up. I can't buy everything, and it's chugged along nicely, so it was a very good, accurate measure. Walmart, I think I've already discussed. Berkshire Hathaway, overbought. Could it continue going upwards as so many of these do? Well, there's your trajectory and your trend line. You look at it if you want to do it based purely upon that, but a bit more risk than I'd want because of concerns over that being overbought. Okay, Eli Lilly, again, we are going to make a killing in this in the future when it starts doing that pattern again, but at the moment it's overbought. And so you're really getting into this on the basis that this is running ahead and it should and would continue. And you can look at the projection of 12 months. I don't do that. I tend to wait until I get a more opportune time to get in. Okay, and it will come in the future and we'll make, as I said, a killing on that doing it. Have a look at this one. Have a look at LinkedIn, where I'm a top voice alongside Mr. Gates indeed. Okay, so do have a look at that. And most importantly, have a look at the campaign for 1 million, where I teach 1 million people how to be better investors. I think you will absolutely love it. Okay, any questions, message me on the comments. Do like and share and follow. Have a look at alpeshpatel.com/links as well. Thank you very much.